Pompier said mute your mics and put off your videos, you did it. But you're back now. All right. In this session, I don't really need to introduce the college because Pankaj already knows all about the college. I would just like to say that, Pankaj is one of the most appropriate person for this session on business finance. He's been able to raise substantial sums of money for clients. So I'm hoping he'll do the same for the college also, Pankaj. Raising substantial sums of money for the college. All right. Just a brief introduction about the day. This is a day that the Institute of Chartered Accountants of India has declared as, National Commerce Education Day. So I congratulate the Department of Commerce for having taken it upon themselves to have some sessions every year. This is the inaugural year. Some sessions whereby they will, engage with practitioners and expose students to what is happening in the world outside. And as I was saying in the earlier session, I think commerce education is the discipline of commerce is perhaps one of the most broad-based disciplines, unlike arts, which is in one area, science in another. Commerce draws from all, it has economics and English from arts, it has maths from science, it has law. There is such a broad base of education that commerce gives you that it opens up several career opportunities for students from a commerce background and also gives them an exposure to disciplines which allows them to choose avenues for higher education once they graduate from commerce. So with that, since we're already running so late, I really warmly welcome Pankaj to this session, and I'm sure we'll all learn a lot from him. Thank you.
Thank you, ma'am.
If you will permit me, we also learned from Pankaj when he was a student. So, yeah.
That's not fair, ma'am.
Yeah.
I now request HOD of Commerce Department, Dr. Shamni Pai, to brief the students about the Commerce Carnival.
Very good afternoon. As Madam Principal has already mentioned, that 10th November is celebrated as a National and World Commerce Education Day with the theme Expanding Horizons of Commerce Education by the Career Counseling Committee of the Institute of Chartered Accountants of India as well as abroad. The main objective of celebrating this day is to spread a message about the significance of commerce education and also by giving the opportunity to the students to showcase their talents. And Commerce Carnival is an event with a series of activities involving the students and faculty. Therefore, Department of Commerce and Management of VVM Sri Damodar College of Commerce and Economics is having a Commerce Carnival today to celebrate National and World Commerce Education Day. We had already one session on this for this event, that is by session on understanding capital market by Mr. Purv Shah. And this is the second session which will be given by our own alumni, CA Pankaj Kakode on finance. And third activity which we are doing today is the commerce quiz. Thank you.
Thank you, Ma'am Shamni. I now request Ms. Melissa Fernandez to introduce the resource person for this session.
It's my privilege to introduce today's resource person, CA Pankaj Kakode. Sir has completed his BCom from our very own college, Sri Damodar College of Commerce and Economics in 1996. He is a certified chartered accountant. In Feb 2016, Sir obtained post-qualification certification on valuation by Institute of Chartered Accountants of India. He has also completed Executive Management course in Management and Finance for experienced chartered accountants from IIM Ahmedabad 2019-20. Presently, Sir is a director and he is also a founder of Kakode Consultants and is also working as a Chief Financial Officer of Health Wheels Private Limited since June 2018. Sir is a founding partner of Kakode Trading LLP. Apart from this, Sir is an active member of Lions Club of Margao and also a trustee of the Jayesh Prabhudesai Welfare Trust, which works with the students. Students and faculty, presenting to you today's resource person, CA Pankaj Kakode. Over to you, ma'am.
Thank you, Melissa. I now request Sir to take over the session.
Thank you. First and foremost, thank you, ma'am, Ms. Prita Malya, for introducing me in such great words. But I think I've learned a lot from her, and I really don't know what I can teach when she is around over here. But having said all of that, I think I've been given the topic of business finance. Can I just switch off the video for the time being because I'm getting some bandwidth issues over here, if you don't mind. Namrata?
Yes, sir.
Yeah, I'll switch off the video and subsequently I'll start it on if you want to click a photograph or something. Yeah, so to begin, business finance is a pretty wide topic and I've been given about 40 minutes to finish it. In fact, our lecture series says it's about 60 lectures, so that would be about 60 hours of topics. Namrata has requested to me finish in 40 minutes. I really don't know how I'm going to go about doing that, but I have structured it in such a manner. Initially, what is business finance and what are the components? Subsequently is where is the deployment of the capital that we raise happens. Sources of capital comes post that. One of the most important things that follows is the cost of capital. And lastly, we will look at capital structuring and why is that important. Some examples from the industry as we go along would also come. A request would be if this could be an interactive session, that actually would be very helpful. So if anybody wants to say something, please feel free to get in touch. Meaning speak up in between and I would be happy to answer that. Just my second experience of doing an online session. So I really don't know whether I'm effective on the online platform. I'm more comfortable delivering lectures in person because I get some body feedback from how people react to the lecture. So I really don't know how it's going to go along today. This is just the second experience. So forgive me if I'm not really up to your expectations today. Having said that, let us commence as we have paucity of time. So what basically is business finance? If I have to go through the meaning of finance, so anything that is required to run the business gets encompassed in the source of business finance. So basically, we do business to make money, and to make money or to run a business, we need money to start the business. And everything that is required to do with money as a part of business is considered as business finance. That, in short, is not a technical definition of business finance, but in general understanding of business finance. So what generally are the components of business finance? Broadly speaking, from a layman's understanding, there should be two broad categories of business finance that one should look at. One part is corporate finance, and I'll touch on that, what that would ideally mean. And the other is the financial management within that. So financial management is the easier bit. Financial management is ensuring that enough and adequate amount of money is kind of delivered to the arms of businesses where they are actually required, having a control over them and ensuring that we effectively use that money to ensure better profitability of the business. Whereas corporate finance is basically kind of trying to tell us where and how we are supposed to raise the money and how effectively we can use money or the finance as an instrument whereby we can become competitive in the industry. So these are basically the two ways, two broad differences between corporate finance and financial management. Now, going a little in detail about corporate finance, that would encompass things like raising of money, capital structuring, a lot of things that we would be talking about today. So my focus would be more on the corporate finance side rather than the financial management side. So the financial management part of it, to give you a brief about financial management, would entail things like working capital management. I think we've got, is it the same class that we have done working capital with? So the entire parameters, this is a different class, right?
Yes, different. Yeah, different.
Okay.
Different.
Okay. So working capital management itself is a topic which can take a couple of lectures if you want to cover it in depth. But working capital management would entail what is the kind of business how much of working capital requirements would be required. Basically, the short-term funding that is required for managing the business is considered as working capital, and the longer gestation projects that require is called as long-term capital of business. So basically, this is the difference between working capital and the long-term capital. Now, how you allocate these resources would be a part of financial management, financial reporting, ensuring that compliances are met, ensuring that budgets are approved, and the numbers that go along those that are coming out of the system are matched against those budget. All those things would form a part of financial management. Now, I personally am more geared towards corporate finance because it is more creative side of the finance. So when I say it's a more creative side of the finance, it every decision that corporate finance guy takes has long-term implications on the business. For example, let us take a case of any organization. It starts right at how much should be the short-term funding and how much should be the long-term funding. How do we kind of source the money for short-term funding and how do we source the money for long-term funding? Should we intentionally borrow more or should we intentionally borrow less? All this will form a part of the corporate finance team. And a good corporate finance team will definitely be an asset to the CEO of the company, because he then will be able to kind of meet some of his profitability targets just by having a good corporate finance team on his side. So a decent corporate finance guy can ensure that the company is actually never starved of money, has got the right equilibrium of money with him, and can ensure that the valuation of the business actually zooms up. Now, at the end of the day, everything that we do is linked to the valuation of the businesses. And I'm speaking of larger organizations. The classic case which I generally like to give out is about Diageo UK. I think I had spoken about it to some of the students some time back. So Diageo UK is in the liquor industry. I think famously known for the black label spirits. So if anybody has a chance and has got an inclination, download the balance sheet and see what their corporate policies look like in terms of finance. So before I move into the other parts, just to kind of give you a gist, they intentionally have a AA rating on their papers. Now, just to tell you, companies with AAA rating can borrow at nearly PLR rates, which are prime lending rates, whereas companies which are just above AA will have to pay a percentage more. But Diageo intentionally has a AA rating. They don't mind paying a little more amount of interest because their valuation of the businesses go up accordingly. So even if they have enough amount of profits, the corporate finance team sits and does a buyback of the shares by borrowing money, and they pay out that as dividend or buyback shares. And that is how a corporate finance team actually adds value. If we were in probably a physical session, I would have written on a board and shown you how that can all be done. But since we are not on the physical session, probably next time when we meet, I could probably enlighten that. Now, having introduced the concepts of corporate finance and financial more towards corporate finance. So the primary thing is about sourcing of money. Now, in whatever respects or whatever names we might call them, there are basically two types of funding. One is equity funding, under which will come special equity, or if you're in US, you'll have Class A shares, Class B shares, non-voting shares. In India, you have DVRs, which have limited voting rights, very rarely issued. I think Tata Motors is one of the only companies which have DVRs out over here. And you will have normal equity shares, preference shares, whatever name you might call it. It's either equity on one side or on debt on the other side. Now on debt is you could again call it anything. You could say a 10-year paper or 2-year paper or a short-term funding. Anything which entails a fixed repayment and a fixed cost is debt, and anything which has got a variable component to it is generally a equity kind of a class. So that is the simple parameter by which you kind of judge whether the papers or whether the funding is either equity or debt. Generally, how do you look at how much amount of money should be raised as equity or how much amount of money should be raised as debt? So ideally everything that is uncertain till your cash flows are uncertain. Everybody aware of cash flows? If somebody could kind of just answer.
Yes,
Ma'am.
sir.
Yeah, so cash flows, everybody knows what cash flows are, right? Hello? Hello? Namrata?
Yes,
Yeah,
you can be heard.
yeah,
Continue.
yeah. So if the cash flows are uncertain, then it does not make sense to have a fixed return kind of a product, which is debt. So unfortunately, now the challenges part within this in India specifically is, unfortunately in India, people are expected to put in equity where actually debt would make sense, and people are expected to put in equity where debt where equity would make sense. So, for example, when you're starting a new business, since the source of capital is limited and we don't have a great equity market for smaller enterprises, we generally go and borrow. Now, when the cash flows are uncertain, borrowing debt has got multiple implications, thereby um, hampering the entire operations of the business. So ideally, what should happen is you should match your certainty of cash flows to the debt that you're borrowing. You look at any of the IT sector companies, which is take the biggest for example, TCS. They don't have any debt on their books because they don't have certainty of revenues. They are all project driven. Today, because we have a project, they have revenue certainty for a very short term to the maturity of the project. So whatever funding of debt that happens would be probably structured to the average size of the project. They will not carry a longer term debt on their books. So big companies have that option. Classic case over here is, if anybody has heard of a company called as Integrid Investment Trust, sorry. So that was a company that was incorporated by Sterlite Power. So what Sterlite Power did was they made the entire project through equity. They sold out the project to Integrid Investment Trust and came out so that they could start another business. And the entire debt was raised by Integrid. So Power being a very uh, annuity kind of a business where the cash flows are pretty certain, they have about 4 or 5 debt equity ratio, which a normal business should never have. And it's a pass through vehicle generally, which is given out over there. So it all the challenge here for a small business tomorrow, if I have to raise money for a smaller business, the challenge here is multifold. One is, for an equity market, we don't have the depth for a small business to go and raise money from the markets. Indian government is trying to address that. They have started on the NAC, a platform for small and medium scale enterprise businesses, but it is still a very illiquid kind of a market. Not many issues do happen over there. One of the only companies from Goa that I know which tried doing it unsuccessfully is Quadros Motors. So they have not been successful in raising money, and they are, because of that, today probably in not a great shape of business. The other side is our bond market is again not very. We don't have a bond market per se beyond a certain level. So unless and until you need about 100 crores of rupees, it doesn't make sense going to the bond market. And why is bond market so important for business? Bond market is really important for business because it gives the promoter the access to a kind of a money without putting his personal liability on line. For example, today, even if I incorporate a private limited company where you would all have been taught till date that the liability of the person is restricted to the amount of capital that is contributed in business. Does that actually work in that sense in real life? No, it does not, because the moment he goes and borrows, the bankers insist that he has to sign his personal liability for the amount that they are borrowing. So which means the promoters have to give their personal liabilities, and his liability there becomes liability of the entire business. So the basic concept of limited liability through a private limited channel goes off. It does have some amount of benefits because it is only where they sign papers with banks that is where the liability becomes unlimited. But apart from that, everywhere else is liability is restricted. Now imagine in US the bond market is so deep that even if a restaurant guy wants to go and borrow money, he'll be able to raise money from a bond market. Indian government is trying to improve that. They've started the gift city in Gujarat. I was hoping that would come to Goa, but I don't think it will happen. So gift city is global international finance center, technology center, something like that, which has come up in Ahmedabad. So hoping that the bond market really develops, there has to be depth in sense, there has to be money which is available to all these people. So if the promoter is not in a position to borrow money without putting his personal liability on the line, his ability to take risk diminishes to that extent. And that is a biggest hamper for Indian businesses going forward. Now, I'm associated with a startup. I'm a CFO of a startup from Mumbai. I can tell you with first-hand experience the kind of problems we face when we go and try and raise money. Risk capital, which should be easily available, which is available in Silicon Valley, to that extent is not available in India. Some marquee people, some marquee investor guys like SoftBank back only IITians out over here in India. So if you have an IIT tag, it becomes that much easier to raise money. But if you don't have an IIT tag, it is that much more difficult. These are the real problems. I'm speaking in real terms as to what is happening in the industry. Now, that is basically the source of capital and some of the challenges as far as sourcing of capital is concerned in India. Now, having raised the money, how do you deploy the money? The deployment is basically in long-term assets and in short-term assets. I'll give you two extreme examples, one from the services industry and one from the, say, a utility service. Now, utility service could be a power sector. Take the example of Tata Power. I don't know how many of you are aware that they have a power plant somewhere in Gujarat called as Mudra Power Plant. They tied up all the finances for Tata Power through borrowings because it's an annuity business. The only element of surprise for Tata Power in that entire thing was they had tied up with Indonesian coal to supply the coal to that Tata Power business. Indonesian government wakes up one day and says, no, we can't export coal out of Indonesia and you have to organize your own sources in India. So the entire calculations of Tata Power goes haywire. Now, they borrowed money and they deployed money in a power plant. Their calculations were all perfect. This is one uncertainty they had not factored in, and because of that, their entire calculations goes off. And I'll come to how to calculate that when we look at cost of capital. So entire calculation goes haywire. So ideally, utility sectors would be tend to have heavy on debt, and services sector should not borrow. Now, generally, when you are studying, the general message that is conveyed is 2:1 is the debt equity ratio that you should be looking at. I hope this is the same thing that is being told, right? So 2:1, a debt equity ratio has to be a part of your capital structure. Ideally, it cannot be the same for all kinds of businesses. So that is something that we will look at in capital structuring part, but it cannot be same for all. So you cannot have a business which does not have huge amount of asset base borrowing large amounts of money. So it has to be linked to what the business is, and how you structure that business will depend on, will determine how you source the money. So your deployment would be in long term. So if it is a TCS, I'm giving you big names so that there is information is from public domain. So TCS is basically a information technology companies. What do they require? They require office space, which is either leased or they are owned, and they require computers. The rest is all their working capital, correct? So, and some amount of research and development, which you amortize over a period of time. Now with IFRS, a company can decide how fast they want to kind of amortize that. So basically a TCS would not have large amounts of money going into long-term kind of funding. So because of that, they cannot have large amounts of debt on its books. So they would prefer to have equity over there. Plus, as I had said earlier, their business model is such that they don't have any stability of revenue. So when you don't have stability of cash flows or revenues, you generally should be avoiding debt. You should be more on the equity side. As far as Tata Power is concerned, Tata Power is one of the biggest power generators of the country. Their projects are all long gestation periods. So they can afford to borrow or structure that in a manner that there is moratorium for the time of gestation of the project, and subsequently the annuity takes care of the repayment of the project. So ideally, if you look, the power sector in India has got about 3 or 4 debt equity ratio. 1:4 is the debt equity ratio. So for every 1 rupee of your own, you generally borrow 4 rupees, 3 rupees or 4 rupees, depending on who the promoters are. So any miscalculations in those projections will result very heavily or poorly on Tata Power's ability to sustain that debt. That is what we are seeing with the Mudra Power project. Whereas because here there is no debt for TCS, even a shock of a small nature, they would be able to withstand much better. So that gets me to the next point is how do we look at capital structuring and the cost of capital. So when we are looking at capital structuring, one of the most important element is the cost of capital. Generally speaking, it is people generally mistake it as the cost of borrowing. Now, the cost of borrowing generally cannot be equated to a cost of capital for multiple reasons because there is a equity involvement in the business. Is cost of capital covered for them? Edwin? Namrata? Ma'am? Any professor, any student? Is cost of capital covered for you?
Yes, sir.
Anyone?
Only the capital structure is explained.
Yes,
So
sir.
not the cost of capital, right?
Not
Only the
much.
capital structure.
Okay, so I'll just so that I can waiver my discussion accordingly. So cost of capital is nothing but the cost of capital of equity and the cost of capital of debt combined. Simplistic example to try and give you is assume you have 100 rupees as your total capital, of which 50 rupees is borrowed and 50 rupees is your own capital. The cost of capital would be the cost of borrowing of that 50 rupees plus the cost of equity of that 50 rupees equated 1:1. For example, if it's 10% and the cost of equity is say 14%, then 5 plus 7 would be the cost of capital. Sorry, 12% would be the cost of capital for this particular company. Now, one of the most important things which people generally overlook when they calculate the cost of debt is the taxation benefit that you generally get. Now, you have the tax break. For example, because the interest gets debited to the P&L account, the marginal rate of tax at which the company is charged to should be deducted from the rate of interest. For example, if a company is paying a 30% rate of, if the company's income tax rate is 30% and the interest rate is 10%, then your cost of debt would be 7% and not 10%. The amount of income tax benefit that the company would get because of the interest would have to be deducted from the cost of debt. As far as cost of equity is concerned, there are various methods whereby you can estimate the cost of equity. One of the most celebrated models is called as the CAPM model, which is capital asset pricing model, which has got a formula risk-free plus the risk premium. But if you have to understand it intrinsically or intuitively as to how to calculate cost of equity, let us assume that you want to start a business tomorrow and you decide that I want to make at least 18% of money on the amount that I invest in this business. Now, if that is your expectation from the business, that 18% becomes the cost of capital. How to arrive at all of that is something which most of the professors would be able to take you through in detail regarding all of this. So or probably when we meet in a class, sometimes, hopefully, then I can explain it to you in much detail. But remember one thing, cost of capital will determine whether we go ahead with the project or not. So when you want to go ahead with any project, you do some amount of NPV calculations. NPV is net present value. So we estimate the revenues or the cash flows going ahead, what those cash flows would look like, and that we discount at the cost of capital. Now, this will all come within the ambit of corporate finance. So when you discount that at the cost of capital, you arrive at some value. If that value is positive, which means we are making more money than what the money is costing us to run this business. If that's a positive number, we decide to go ahead. If it's not a positive number, then we generally avoid that project. So how do we optimize the cost of capital? Because debt is always cheaper. Can we just go ahead and borrow any amount of debt? It cannot be, that cannot be the reason. You will have to balance it out so that you have an optimal cost structure. That will be a determinant of what kind of a business you run, how long is the project or the business going to sustain itself, so on and so forth. For example, Reliance Industries of late has gone on record to say that by March 2021, we will be a net cash company, or which means a zero debt company. Does that mean the Reliance group will not be borrowing any more money? They would be borrowing more money as and when they find projects which are of importance to them. At the moment, their deployment of cash is over in Jio, in Reliance Retail, and so on and so forth. So probably Mr. Ambani would be thinking of what next, and that is the time he would approach the markets again. If not, his cost of capital goes up so much higher, which will result in his equity prices going down. So at some point in time, he will have to restructure his capital base accordingly so that he can value of Reliance Group per se starts looking differently from where it is. Now, if anybody is from the markets, they would see that or follows the stock markets, they would see that Reliance stocks did nothing from 2010 till about 2016 or 17. And sometime in between, when the Jio started delivering or Jio was launched, that is the time they started expecting that the revenues would now start flowing in. And that is the time the stock prices started going up. So if you understand the uncertainty, how to relate it to corporate finance is something like that. The uncertainty regarding the cash flows started crystallizing into cash flows coming in. So that uncertainty was giving way. Because there was uncertainty, the cost of capital was considered to be a little higher than what it ideally should have been. The moment there was certainty, the cost of capital drops down, and that is why Reliance shares started pricing upwards. So understand one thing, if you are a serious student of accounts or if you're serious students of finance, you can probably understand balance sheets and valuations in a much different light. The last part, I think it's 12:45, another 10 minutes and then or 5 minutes, and we can take questions if there are any. The last part is the capital structuring part. The most important of everything is tomorrow when you want to start a business. How do you decide how much amount should be borrowed and how much amount should be your own money? Given a choice, if I know the certainty of the business, I would borrow 100%. For example, today I decide that, I want to say trade something, say trade iron ore to China, where I have a perfect order, which is I have a letter of credit from a Chinese company for say X dollars. I don't have money, but I can borrow the entire money against that LC, ship that and make the money. In a situation like this, where your cash flows are absolutely certain, you can go right up to whatever is your leverage and take care of it. Now, why do we need a good capital structure? Because it makes your taxation effective. The dividends that you pay out on equity do not get a tax break. What I mean is your dividend payout is not charged above the net profit line. It is below the net profit line. You've done your accounts, right? So which means your tax calculations happen then your net profit is considered, and then the dividend is allocated from the net profits. Whereas if you borrow money, the interest components goes above the net profit line, then the income tax is calculated. So to that extent, you pay less amount of taxes, and then your net profit is calculated. So one is how much benefit should we derive on the base from income tax? That would be one. That would again be sustained with the kind of business that we are doing. And finally, there is something called as a leverage. Leverage is nothing but the debt equity ratio. How much am I willing to borrow from the system? How much am I comfortable borrowing from the system in accordance to the money that I have of my own to deploy? Now, as a company, there could be guidelines. As an individual, if you want to start a business, it depends on your comfort level. Now, keeping all of this in mind, you would have to structure your capital structure accordingly. Couple of important things is, if any of you wants to start a business, is determine what kind of long-term assets would be required. Ideally, that should form your debt, depending again on the cash flows. And whatever is the short term, a part of that should also should be your own funding. So general perception is the entire long-term funding should come from equity, which is not necessarily true. So in colleges, or at least when I was a student, even during chartered accountancy, my books taught me that the entire long-term funding should ideally be equity and so on and so forth. That need not necessarily be the case. It will all depend on the kind of business and the certainty of cash flows that you have, and the comfort level as an organization or as an individual you have to the amount of borrowings. Now, if you sit on the other side as an analyst, would I be willing to invest in a company which has got more amount of debt on its books? Personally, I generally shun away from companies which has got a high leverage. Why? Because in times when businesses tend to not do so well, those are the companies which will have higher cost implications, because interest is a fixed payout. For example, companies which suffered greatly in value during the COVID times were all the companies that were levered higher. So companies which were not levered were still okay, because they didn't have to that extent a liability on their balance sheet. So this, in short, was an introduction and some of the challenges in real life of business. Sorry, I think I've finished within the given time. If 10 minutes for question and answer, if anybody has them. And I hope I did make some sense. Hello?
Thank you, sir. It was a real informative and inspiring session. Now I request Dr. Madanan to moderate the question and answer round.
Students, if you have any questions, you can please type those questions in the chat box.
And I would appreciate a honest feedback. I mean, was it okay? Because I'm very uncomfortable doing this online business.
Pankaj, you are good. Excellent.
Thank you.
Yeah.
It was real informative session, sir.
Since we don't have any questions, over to you, Namrata.
Don't seem to be any questions. Students, please ask.
So my fear is always this: if there are no
Pankaj.
questions, it's either they've not understood everything or they've understood everything. Meaning they've understood nothing or they've understood everything. Understanding everything is very difficult. So I can only assume they've not understood anything.
No, or maybe they're not like you, not asking. Students, please ask. Let's get some questions, students. Come on.
Yes, there are 65 of us and no questions. Wow. Okay.
Maybe in the face-to-face session, Pankaj, some other
Probably. That would be much better.
yeah, when things are back to normal.
Yeah, sure.
Yeah.
So,
I now
can we call it a day?
Yes, sir.
Can we call it a day?
No, sir. Now I request Dr. Edwin Barreto, BCom coordinator, to give his concluding remarks.
Okay, good afternoon. Damodar College continuously organizes activities in different areas on a regular basis for students to broaden their perspective. Today being celebrated as World and National Commerce Education Day, Damodar College is the first college in Goa to celebrate this day. CA Pankaj Kakode has been a brilliant alumni and a successful professional consultant. He was my junior in college. My friends used to tell me that whenever a teacher is to dictate problems in the classroom, Pankaj was solving those problems. By the time the teacher was done with dictating the problem, Pankaj's solution was ready. That was the caliber of Pankaj. Finance today is the functional process of business which helps to meet business goals and objectives with responsibility to acquire funds, manage funds, and also plan the expenditure on various aspects of business. CA Pankaj has explained in simple words the intricacies of business finance. He has covered different areas like meaning, components, especially corporate finance, sources of finance, valuation of finance, deployment of finance, then cost of structure, then capital structure, and he has explained all these concepts with live examples from the industry to connect each and every aspect of business finance. I'm sure all the participants are enriched with today's sessions organized by Department of Commerce and Management. Say, Pankaj, thank you very much for a wonderful session. See you for more such sessions like this. Thank you very much.
Thanks, Edwin. But I guess you got some facts wrong. I don't remember solving problems as as teachers used to dictate.
You're the stuff of legends, Pankaj.
Sorry?
You're the stuff of legends now.
No, nothing like that. Yeah. Thank you, ma'am. Thank you for the opportunity. Yeah.
Thank you.
Thank you, Sir
Yeah.
Edwin.
Yeah.
Gratitude is an important part of every successful activity. So now I request Mrs. Anupama to propose the vote of thanks.
Hello, good afternoon everyone. I, on behalf of Department of Commerce and Management, would like to take this opportunity to thank our today's resource person, CA Pankaj Pai Kakode, for gracing our session and giving us valuable insights into business finance and making our Commerce Carnival much more special. A big thank you to our principal and professor, Dr. Preeta Malya, for giving us this opportunity. I extend my thanks to our HOD, Dr. Shami Pai, and BCom coordinator, Dr. Edwin Barreto. I'm also thankful to the event coordinators, Dr. Maithili Naik and Ms. Muktali Kukonikar. I'm also grateful to the IT department for helping us with all the arrangements. I'm immensely thankful to all the participants for attending the session and making it a great success. Thank you, one and all. Thank you.
Thank you.
I really want to thank Pankaj Kakode for accepting the invite at very short notice. Have a nice day.
Thank you so much. Thank you. It's been a